Hello, coming at you today on August 18th, 2015. We're going to be following up on the previous two videos, which you can see. In fact, I strongly urge you to watch those before trying to understand what we'll cover in this video. So go to eminitraderpro.com and under free education you'll see the videos, market structure, volume profile, process simplified. Parts 1 and 2 are there. And today we're going to carry on by looking at a couple of simple strategies to use along with the analysis that we were learning about in those two videos. Now, of course, before that, I urge everyone to seriously consider that futures trading contains substantial risk and is not for every investor. An investor could potentially lose more, all or more, than the initial investment. Risk capital money that can be lost without jeopardizing one's financial security or lifestyle is how we have to limit our activities with these kinds of parameters. Only risk capital should use for trading. Only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. So now let's continue on today with the topic that we examined in the last two videos from the perspective of how am I going to use this knowledge of market structure, volume profile in this very simplified way using simple ordinary candlesticks. How am I going to know when to get a trade? Because we're gaining an understanding, which, as I said in those videos, I believe if you don't have that understanding of how the market consistently moves day in and day out, then you're going to, I think, have a very difficult time being comfortable enough, being familiar enough in the trading environment to do better than all the other traders. 95% of which fail. You might be in that losing 5%. So let's continue today by looking at today's trading. And we're going to take it a little bit farther in terms of how do we identify a time to pull the trigger with this kind of picture and structure and footprint and parameters, variables, everything's kind of being laid out into a nice graphic pictorial. But when do we feel comfortable with actually executing a trade? Now, the first thing I would say going in, let's say you come in around the Central Time open, 8:30 a.m. Central Time. And as I showed you in the other videos, right in that first minute, I draw this little red box to show you the opening 1 minute went from here to here. That's why the pink box goes all the way across. And you can see the market jockeyed below, similar range above, tried a long time, whatever this resistance is here, and we talked about this. This is the open. The blue line I used is for the night session open the day before. And this is the prior day's high up here. And this is early morning after midnight and the 8:30 open. This was the high, so that's a significant level right under the prior day high. So the question is coming in, let's say you're looking right here at the open, what are they going to do today? Are they going to break through the trade above the open or below the open? That's the first thing, the night session open. Then the next question is, are they going to trade above or below that 1 minute range right off the opening bell? And then the next question is, if they decide they're going to trade above it, are they breaking through these two obvious basic starting points if the market's going to trend higher? And the same thing down here. The pivot forms a logical testing point to see if they can break under it or not. And that's exactly what the market did. You'll see this happen day after day after day. These vital statistics of the prior day's trading are the structure, the framework, the foundation for the participants in the market seeing indications of strength or weakness. If they see indications in weakness, then they'll want to get on the short side. If they see indications of strength, they want to get on the upside. So we always can look at these points of logical resistance or logical support and know very soon after that those levels have been tested that we want to really have a bias in the opposite direction of wherever there was a failure. It's that simple. Now, what I like to do is look at a 30-minute chart before I start looking. In fact, I look at it all day long, having a couple of monitors, and one that you don't see on this screen is right next to it here in the middle of 3 monitors. And here is what I see right to the left of this screen is this 30-minute with those same levels marked, the previous day's high. Now we're looking at this. This is at 11 the night before. This is midnight. And, at midnight right away they decided they were going to trade under the previous day's high. And this is where they opened in the night session. And they, after this few hours after midnight, they identified a level underneath the night session open, underneath the previous day's high. And then over here, that 30-minute bar at 8 in the morning Central and then 8:30, the market stayed under that night session open. And all the way up here to the 10:30 bar, it was trading above the pivot but not showing any strength to get above the night session open. Now, looking at the 30-minute, you could say, and again, this is hindsight, well, I would have liked to be a buyer down here. They were obviously bouncing off the pivot. And I might want to be a seller under the close because it would allow a tight stop and because they rejected it in the earlier trading, so maybe they're not ready to break it out yet. So those are kinds of the foundational understanding from a 30-minute chart. And that's where the 1-minute chart comes in, where you get kind of the traditional charting perspective, and you get this perspective that I'm emphasizing, where I'm looking to the left of the chart and identifying where I see the participation was clearly rejected at some outer limit of what the fair value was that day. Now, this is the fair value through all the way up to, let's say, the whole morning, almost up till noon. The fair value was in the middle. It was above the pivot, below the night session open, below the prior day high, and they were rotating, and they continually stopped just short of the previous night session open. So the question is, how do you get a trade out of that? And that's the difference. That's what we're looking at a little bit, with a little bit more emphasis today. Well, first of all, this 1-minute open created that, and you can refer back, I urge you to refer back to the last 2 videos we did, parts 1 and 2, the market structure, volume profile process simplified. And we talked about this when the market goes down to a low, whatever was the highest, whatever was the lowest pivot before that low, that's what I call the last pivot back, and that's a level that they have to get through if they have any hope of turning this sort of brief downtrend into an uptrend again. So I draw, there's only, at any given time, there should only be 2 of those that are active. One if it's coming off a high, then you have lower highs, lower lows, lower highs, lower lows. The lower high right before the lowest high that's before the lowest low would be the last pivot back. Now in this case, it was a pretty big range compared to the range of the day, especially the day session open. So it's way back up there, but still, I'm not going to really have a bullish bias till I see them break that to the upside. Now, when they get to that last pivot back, that is when I'm going to start seeing, is it going to break it, or is it just going to do what we call a probe? Is it going to go through it and then fail and come back down? Or is it going to waffle? Waffle means waffling up and down. No clear decision made yet. Now, what we're seeing here on this chart, I've drawn these green boxes for you to show you this 3 highs up here, 3 lows down here, 3 lows here, 3 lower highs here, 3 highs on 3 barely slightly higher highs on the way up off of the low, and then 3 highs over here. Now I find this is something that comes up day after day, lots of times, many times a day, over and over and over. This principle of triple bottoms, triple tops, 3 drives to a high, 3 very shallow, farther drives in this case, or 3 lower highs after some attempt, showing a lot of weakness. Every time they try to go back up to this high, they sold a little lower. Then they started selling earlier here, even earlier here. So basically, the participants in this trading auction process were very convinced that it was going to go down, so they didn't want to let it go higher. They didn't want to hold out and try to sell up here, because the market was telling them it wasn't going to make it all the way back up. People were selling it earlier, then they sold it earlier, then they sold it earlier. So they weren't waiting for such a great trade so far off the low. They were willing to take whatever comes along. They wanted to jump on this one because they expected it. Or maybe they were just all the guys with all the money, the majority of the big money traders, so they have more influence. Whatever, however you want to look at it, you're just guessing a psychological game. But what I'm showing you here is we're just looking at objective price action, market structure, and patterns. Here you have a shooting star. So the last bar on this little spike rally here off of this short covering off of this low, basically, a little shooting star. It shot up and then closed way back down on the low tick at the end of the bar. And that's just a 1 minute period. Now over here you got a double top on these 2 bars in this little short rally here. So this is an opportunity every time it comes up. You're identifying what's going on here in the first few minutes of trading, 7, 8, 9, 10 minutes in, and then you see it break down below the minute opening range. But you're waiting to see, maybe you can get in on some pullback, but you want to see if it's going to break some important support or not. If it gives you 3 bottoms like this, then you're interested in selling rallies. If you can get a rally anywhere into the opening minute range, very soon after it's been trading to the downside, that could be a good trade. Now, you don't want to wait. The problem with waiting is the next time they might make it through. So you could actually see this here as another high, or maybe you could call that a high. You could call this a high. You might want to sell when it gets back to the opening range here. You might want to sell when it gets up into the opening range farther here. And then you could maybe have this as another selling opportunity. This is my pattern that I favor so much, is what I call the stop-run hook. When it runs a stop by a few ticks, it's a very high percentage trade, low risk, because it's only going a few ticks through. So if you sell on a limit order here, you're only down 3-4 ticks, and you can expect it to at least go just like it did, at least to the other side of that 1 minute opening range. In this case, you're selling a shooting star here and a long stem bar here, and maybe what they call a piercing line or inside bar, then your target on these trades, if you're selling considering this resistance, would be down here at the daily pivot again. So this is what we do. We look at our money management, we look at the patterns, and we identify high probability where the risk is low, but we have an identifiable target. And when you saw this third high here, with 3 little highs inside of it, by the way, That's a very high percentage trade, and you'd expect it to go at least into the opening range, maybe all the way back outside the opening range. But because you just had it stop, you had it fail up here. So this is what they call a retest failure when you see the second box. It's a retest failure when you see the third box. When you got a triple high, you could consider this the first retest was a lower high. Then you had two equally high tops, double top. Now you got two equally high tops and then a third one. So it's a triple top after a triple top, basically. Those are high percentage trades. This is what people, because the market isn't showing a willingness to break through that resistance. And if it fails after a long time here, an hour or so, then odds are it'll at least go back down here to the pivot again. So these are the kinds of trades we're looking for. And I'm going to continue on part 2 and see if we can go a little bit more deeply into this and get a little bit more clear about some logical, strategic thinking in the midst of this market profile structure that we're able to identify with the ordinary candlesticks. So look for video part 2.